Okay, welcome everyone to the second edition of OzStocxs. This week we're going to review the stock CSL listed on the ASX. I'm just going to give a quick overview of CSL. So CSL actually stands for Commonwealth Serum Laboratories. This used to be a government-owned healthcare company, which was eventually privatized and listed on the Australian Stock Exchange. Listed in 1994, so there's a long track record for anybody who likes to go back and look at 10 years worth of annual reports. There's plenty of history and metrics and data on CSL for anybody who wants to do some in-depth long history research. The ticker code is CSL, which is the abbreviation for its name. As I say, it's in the healthcare sector, by and large the biotechnology sector. It's got a market cap of 126 billion Australian dollars. So it is in the top 10 stocks in Australia and one of the largest stocks listed on this exchange. As I say, it's the third largest stock on the ASX currently. At one point last year was actually the largest stock listed on the ASX. Right now it's behind Commonwealth Bank of Australia, which is the largest bank in Australia, and BHP Group, the iron ore miner, is currently second. As I say, it's the biggest healthcare stock currently on the ASX, and that is quite a feat when you consider some of its competition, especially at the large cap end, with global healthcare leaders like ResMed and Cochlear. Not only is it the biggest healthcare stock in the ASX, it's also the second largest biotechnology company in the world, behind the mighty Amgen, its American-based rival. CSL, so what does it do? It's got two main divisions, CSL Behring and Seqirus. So CSL Behring deals with specialist blood products, primarily around blood plasma. So CSL collects blood plasma to treat a whole host of blood-related diseases and conditions, such as haemophilia, perioperative blood products. So that's when you're in having surgery. So you might have uncontrolled bleeding, or they're giving you certain drugs ahead of a certain operation or after a certain operation. And they are a world leader in this space in terms of blood plasma related products, and are continuing R&D in this space. Seqirus, they acquired from Novartis a few years ago. It deals with seasonal influenza vaccines, obviously very topical now with COVID, but actually not linked with COVID currently. These are the kind of annual flu shots that are recommended by doctors, healthcare professionals, that a lot of people would be receiving on a yearly basis. Primarily the market's more EU and the US, but I think long term, as a result of COVID, I think there's going to be a lot more interest in annual boosters, whether that be COVID boosters, just getting flu vaccines, full stop. So while nobody could have foreseen the pandemic, I think acquiring this business from Novartis a few years ago would look like a much more attractive business today if they were trying to buy it from Novartis. Revenues, 55% of its revenue comes from the US, 30% from the EU, 11% from Asia Pac, and only 4% from the rest of the world. And I think that's the key point when you're looking at CSL. It's quite heavily penetrated within developed markets of the US and Europe, and then obviously Australia, New Zealand, it's kind of home base, and a little bit up into China and Southeast Asia. But by and large, that whole emerging market scene, whether that's in Asia or in South America or anything to do with Africa, is ripe for further penetration by CSL and its products. So despite its size and I guess its long history, it still has a huge runway of growth ahead of it, in my opinion. It's on a PE of 40. Currently, they're just about to release results in the next week or so for the half year up to December. But bear in mind it's managed to grow earnings at 14.4% over the last decade. So it's got quite impressive earnings growth. Yields just over 1% Aussie, but again, that dividend has grown 13.8%, over the last decade, kind of in lockstep with earnings. Probably the most interesting fact, despite growing, its dividend at quite a high rate, its payout ratio only today equates to about 45% despite that growth. Now, a lot of money needs to be reinvested into R&D, and they're currently, trying to get a whole host of new products into market. So, they do have to keep back capital for R&D, but it does give you a sense of the flexibility that they have around the dividend, that they can grow it, invest in R&D, and have capital available if and when they need to. The return metrics, as you would expect for a healthcare biotechnology company, look very, very good. Return on assets 17.9, return on equity 42, return on capital employed 26, and that's over the last decade. That's not just the last period. So, and again, an impressive history of returns on shareholder capital, but also being able to, more crucially, reinvest those returns at high rates over a long period of time. EBITDA margins are circa 30%. Its operating margins are circa 22%. So, very healthy margins. My one concern with CSL, if you want to nitpick, its debt has ticked up over the last 4 or 5 years, partially due to the Seqirus acquisition from Novartis, and the kind of elevated debt levels will have an effect on those return on equity numbers and return on capital employed numbers. But I mean, its net debt to EBITDA is still only 1.5 times, and given the cash flows that this business generates about 4 billion in free cash flow every year, it's not something to get overly concerned with. But it is, I guess, a change from where the business was 10 years ago in terms of the overall debt level within the business. Now, with interest rates so low globally, you could say that the board and management are taking advantage of the low debt levels, given what they can reinvest that money at internally. So it's a bit of a double-edged sword in terms of debt. I just naturally not a big fan of debt, but in some cases it does make sense. So overall with CSL, what would I say? Look, you're paying up for quality. There's no two ways about it. Paying 40 times earnings, which is even historically high for a business like CSL. It normally had traded kind of in the mid-20s. The last year or two has gone up to around that 40 level. But you got to bear that in mind in the interest rate environment that we're in currently. Just in context then of where that would be in the Australian market overall, generally has a P of around 15 times. Currently it's up around 18 or 19, mirroring global kind of stock markets. Whether you look at Schiller PEs or any kind of long-term PEs, where markets are trading now versus their long-term averages, it's elevated, and CSL's individual PE is elevated where it has traded over the long term. But with the return metrics it has, the opportunities it has to reinvest at high rates, and the fact that it has showed a willingness to return capital to shareholders via dividends over time, I still think it's a quality blue chip in Australia, and it's definitely one stock that I would look at if you're going to be looking at Australian stocks for the first time. Our weekly kind of updates will kind of mirror this. It's going to be 2-3 slides. I don't want to get too in depth into it. I just want to give you a flavor of stocks, ideas. You can say, a lot of people say talk about deep dives. This is more a quick, shallow dive into one stock where it can be a launch pad for you to go and look at more stocks. So if you want me to review a certain stock, please let me know. You can comment on the video below, and I'll be checking out all the comments. And I will speak to you next week, where we'll review another ASX stock.